Everybody, Corey from, well, let's try that again. Hey, everybody, Corey from SB Pace here, and we are talking about everything that's left over here in the month of March. We are almost done with this project that we started almost a year ago, and the question for today is, what exactly are the three sheets anyway? Well, there's three basic financial sheets that every business out there should have. Every publicly traded company does have. It's gonna be your income statement, which is commonly known as your P&L or your profit and loss statement, your balance sheet, and your statement of cash flows. And those three things together should be able to tell you everything you need to know financially about a business. Your income statement or your profit and loss, that's exactly what it does. That's what it tells you, is what your revenues are, what your expenses are, and what your net profit is. And a lot of people look at that net profit and say, oh, look at that, it's positive. That's a good thing. Generally that is, but that's not always the case. You have your balance sheet, which is going to be your assets, which equals to your liabilities and equity. Your assets and liabilities are broken up into short-term and long-term. Your equity is everything that's like your company owns, so that's retained earnings or capital stock, things like that. And a lot of your ratios for determining the value of your business are going to come from there, or how profitable you are, how liquid, that type of stuff. And then lastly, my favorite, the statement of cash flows, which is basically shows you all your sources and uses of cash in your business. And this is one that a lot of people don't really pay attention to, especially small business owners, because it's the P&L. It gives you a pretty good idea of of what's going on in your business, but that statement of cash flows really tells you what's going on with your cash. So your net income feeds into that, all the different places where you get money in regular operations, all the money where you make or spend money investing, and then all the money that you either get or spend in financing. And that's the killer right there. That's what often gets businesses, is that you have, especially, well, financing and investing, is you've got this net positive net profit, but you're bleeding yourself, you're bleeding cash, because you are paying back money that you borrowed. You are paying yourself too much. There's all these cash outflows that appear on the statement of cash flows that appear nowhere else on your balance sheet, or your three sheets, really anywhere. And so while you have a net profit, if you're spending a ton of money paying off loans or paying yourself or investors or any of those things, your cash outflow could be greater than your cash inflow, which means that at some point you're going to run out of cash. So in a very high level nutshell, that is what the three sheets are.